mean, you mentioned energy markets, and energy markets are, again, making headlines as they have for the past couple of weeks as we see both high prices and shortages spreading from Europe really across the globe. I mean, I'd like to know, I mean, how do you see this?
I think there are, I would say, a sort of just a short-term effect, which is, I think, the post-COVID recovery of the economy. Clearly, we have a sort of high growth, too high somewhere. I think the global system of the planet is not designed to absorb suddenly plus 6, 7% of growth. That's a lesson in particular. So that's something which is just a short-term impact, and I think we'll get out of it. We see that not only for energy, we see that in many commodities, in logistics. So you have a global supply chain of the world planet, which is not designed, I would say, to accommodate such a big growth. The second effect, I think, is clearly more related to oil energy markets, and in fact, more fundamentally to the energy markets. There is a strong demand for gas, for sure, in Asia, in China. It's also, I think, an impact, all this crisis, of more transition, energy transition, which has two impacts. One is that you invest less, or you have pressure to invest less, not only because of transition, but COVID as well, in oil and gas. You know, we see less capex in oil and gas, and that obviously, and last year from this perspective, had a short-term impact. You know, we were cutting all the short cycles capex, and so all these wells, all these rigs which have been stopped, we don't have the production this year, we'll not have it tomorrow. That means this short-term production has disappeared. It's spectacular in the US, by the way, with shale oil. So that's one point. So that's an impact of, I would say, and I suspect it might continue because, again, the COP26 and companies like TotalEnergies, not only we are disciplined, but we shift part of our capex to other energies, and other of my peers have done the same. So I think less capex, and of course we know that there is a natural decline in oil and gas. So you have an impact of which might be longer than we think. The second impact is that with the transition, we introduce in the electrical systems more and more intermittence, uncontrollable assets. It's nice, wind, solar, and hydro, but it depends on the wind force, on the rain, on the solar. So that means that you have an electrical system with a lot of assets which are easily actionable for low cost, but which, when there is no wind or no rain, you have a lack, and then you go to, you need to have some controllable assets, gas-fired power plants, so coal for gas, because it's easy to turn off or on, you know, so that's another effect. So what we discover as well is that everything is interconnected. You know, what happens in China on the gas will reflect on Europe. You have the CO2 pricing in Europe, which is also pushing pricing up. So it's energy system is a complex system, and people should understand that all that is interconnected.
Returns and renewables still are a big sticking point for analysts, for investors, I think. So what I'm wondering is, how can you maintain renewables returns? It looks like, you know, in certain mature markets, returns have dropped, not necessarily for Total's portfolio, as you said in your analyst day, but for many. You know, talk to me about the strategies that Total has available to maintain renewables returns as it gets, you know, more ambitious in its targets for renewable power.
But I mean, there are different markets for renewables. You have the, I would say, unregulated markets, the US, Europe, whereas you still could have some PPAs in Europe, but fundamentally it's commodities markets, and you have a lot of it's going through tenders, a lot of, I would say, competition. So, of course, you have a trend to decrease the returns. And we are very honest. We said that in this type of markets, we start from 4%, we can go up to 8 to 10%. But you have other markets, like we've done in India. You know, in India, we have invested this year, beginning of the year, $2 billion by acquiring 20% of Adani Green, which is the largest solar developer in India. These $2 billion today are worth $5 billion. So we can create value within renewables, but you have to be smart. You have not to go to competition, you know. And like in Iraq, the profitability of the solar project in Iraq is higher than the returns I just mentioned, quite higher. The advantage with renewable, my answer is always the same. You have different markets. If you go where everybody goes, you have a chance, but this was true for oil and gas. You know, when you have strong competition, the returns were lower. If you are able to differentiate yourself, but the planet for the demand for renewables is huge. Many countries around the planet, and with climate change, if everybody is serious, there is 3,000 gigawatts to be built in the next 10 years. So our ambition as Total is to build 3% of that. So we want to have a market share of 3% of the growth for renewables. So the question is, can you find 3% of this market in areas where you could maintain an average return of more than 10%? Our answer is yes, we can do it.